Hello and welcome at Stocks Advisor. Today's video is dedicated to a main question that many subscribers have. It's actually how it works, how we do analysis at our channel, what is behind the model that we use, what are the arguments for it, and actually how we do it, why should it work, and what are reasons of what we are doing, behind what we are doing. So today it will be maybe a little bit boring video for those who already know it, but if you want to know how we work and what's behind our ideas, we can actually talk about it now. So let's talk how it works. First of all, of course, when you think of trading of stocks, you need to understand what type of trader you are, so what you want to do, because this will define your general strategy. And once you have it, I'm not going to talk now about actually what you do and how you do. This is about let's say up to you. So how you trade, you need to decide yourself, and this could be different types of trades. So you could be a trader for fundamentals, you could be traders for options, short traders, intraday, let's say a bit more long-term trader, etc. So these are there are many strategies available, and we're not going to touch those. We will talk about the model, the strategy that is used at our channel. So what we do is actually including technical analysis trading. It's not completely technical one. I will now explain more. So we do trade over daily candles, and we do trade with including technical analysis plus risk mitigation. So what we do I will talk now more about it. So what we do at our channel actually is a technical trade plus risk mitigation. Why is it important? Because technical trade, as you maybe have heard, has, let's say, many pros and cons, and there are some ideas or sayings that maybe it's so-called a posteriori discussion or a posteriori model, that situation already developed and then it works. But if you want to look forward, if you want to foresee the situation of the candles on the charts actually before you know what would actually happen, then it's quite hard to predict. It's yes and no, and it's the reason for that is because there are risks you need to take into account. It's mainly about thinking of what are, let's say, chances to go high, what are the chances to go low, and you need to take this into account and mitigate, let's say, negative risks. And that's all about, that's why we have the second part here, which is called risk mitigation. And now the question is how we choose the stocks and how actually it goes to that level. So to understand this, how we choose the stocks and why technical analysis works and why sometimes people think it doesn't work, we need to understand actually what drives the let's say the stock price or actually any ticker price. And there are, of course, there are many types to, let's say, classify it, but I like the classical 4 levels approach, so classification of 4 levels. And the first thing that let's write it like this: what drives stock price? And there are, of course, in general 4 major things. It's nothing new, it's known, but just to let you know why is it important and why we take it into account. So first of all, one thing when we're talking about companies, it's company itself, and it's company and its fundamentals. So these are the things that in general are known. You can really find them everywhere, open sources, and this is one style of trading, and as I said at the beginning, but it's something that drives the price. So there are situations when company fundamentals and the company itself is so powerful, it's so trusted, results are so good that it just drives the price up. So this is one thing. The second thing that might drive your price up or down, doesn't matter, so actually that can dominate on your price formation, is so-called market drivers. These could be many things. These could be market manipulations. These could be kind of upwards, downwards pressures, could be short interest, could be options, could be all other, let's say, indirect, not completely technical approaches, let's say technical methods that can drive your price. Because when you do technical analysis purely, you don't think about volume of shorts, amount of options, if there is any market manipulator involved, if there are big guys, let's say, interested. They are still there, of course, you can see it on charts, but this is the information that sometimes might be stronger than the technical stuff, and it could drive your price. So this is the second thing. The third thing that might develop or drive your price formation, actually, these are news. News could be both positive and negative. These are really some sudden things that you cannot anticipate at all, because fundamentals you kind of can anticipate. Let's say you can see where the company is going, what would be the probability of something. But news are like a bank. They come, they could push it up, push it down. Especially it's very nicely seen for pharmaceutical companies. In that market, any news could kill or kiss the stock. It's just bless or curse. So it could be really a strong thing. And of course, on these situations, no technical analysis works, and it cannot work. And of course, the fourth thing that drives the price, it's technicals or technical situation. This is very important. So those who approach market stocks trading as a technical traders, they of course want to trade on the fourth parameter, on so-called technical situations. But the question is, when is it working? How do you know the current price is developed or is caused by the technical situation or by the chart? Because there are four, you can see there are four major drivers that could dominate and could dictate what the price will be. So first of all, what you need to do is you need to find a stock which is currently at the moment is driven by technical situation. So this way, it's very hard. It's actually one of the strongest, let's say, knowledges that you can experiences. So if you can find a stock that is driven purely at the moment only by technical situation, which price is driven by technical situation, then you can apply all those technical instruments. If you are not in this position, or if you are entering into the stock which is currently dominated by news or other market drivers or company fundamentals or something like that, you will be like thinking, oh, it should go down or up due to technical approach, but it's not. And the reason for that is because it's not dominated by technical situation. It's not the driver that is working now. So first of all, when you choose a stock, you need to choose a stock that is whose price is dictated by technical situation. Sometimes you could be wrong. Sometimes it might be that suddenly it will go out of the area when the technical situation dominates the price, and it could go to one of those three. Let's say it could be first, second, or third. And these are the risks that can happen. So this is the risk that you take, the risk of mistake. And that's why I said at the beginning of this video, the way we do it at our channel, we choose stocks. So we don't show how we choose. We have special programs written that scan through the US-based stocks daily. Special algorithms, they choose the stocks, they pick up the stocks that are driven by technical situation. That's why I said we are trading with technicals. But, as I said also, it might be that either you are mistaken or we are mistaken, or suddenly another one of those first three drivers kick in. And these are our risks we need to take into account. And that's why I said what we do risk mitigation. And this is our fundamental of trading. So this is our basic of trading. That's how we trade. So we pick up the stocks that are currently in the technical driven situation. So their price is dictated by technicals, but also we discuss in our video how to solve the problem if it suddenly goes and the price is driven to the area where it's, let's say, driven by first three drivers. And that's what we do, the risk mitigation. So how it works then at our channel? So at our channel, we always talk about 3 levels. So those 3 levels are spread through these 2, let's say, technical and risk mitigation, through these 2 points. So first 2 levels we always have. So we always have 3 levels at our channel when we talk about. These are the levels where you can buy in. So you can buy at those. I will talk about it more. Let's say I will explain it more now, in more details now. But first of all, we have 2 levels that are technicals. So 2 levels we always keep for technicals. Technical levels for technical trading, and the 3rd level, the last 3rd level, so the 1 level, let's say the 3rd level, we always keep for risk mitigation, and that's how we trade. So we have 2 technical levels, and the 3rd level is a risk mitigation. So this way we always want to first we trade, and I will talk also now why 2 levels for technical. So we start trading as technical. So first we pick up the stocks that are a technical situation. Then we do discuss 2 levels of technicals, which are the price levels that we can expect, and we keep the 3rd one for risk mitigation. So if you do it now schematically, how would it work then? It would work like this. So first we choose a stock in a technical drive, which is driven, which price is driven by, let's say, technical chart, by technical analysis. So where you can apply your technical analysis. Let's put it in blue. Secondly, we need to take into account risk. So we talk about 3 levels. 3 levels. 2 levels are technical. And the 3rd one is 1 level is risk mitigation. So for risks. Why is that like this? Because as I said, the position can go to a non-technical level. And then we also, we buy for those levels. So why we do 2 levels? Because imagine you have first level. So certain area, there is some, let's say, price volatility, and then you have your first level. So how it usually works, you have your first level. And then we say, okay, you can buy in this first level. It's a technical level where the price should rebound. We always play on rebounds. So it's always bullish. It's not bearish. So we think, okay, the price will go here in the first level, maybe volatile inside, and then we expect it goes up. Then we say also when you need to sell it. So we give you so-called a profit estimation. This is the 3rd thing we do. It's a profit estimation, or it's actually the moment when you need to take your profit. So this is another, let's say, the 3rd step that we do. And then how you trade, you buy through the first technical level. We will talk later how we buy. So you buy in your first technical level, and then when price goes up and there is it hits the profit estimation, usually given in percentage, you sell, you take your profit. And this is the end of discussion. This is the analysis. If the first level played, you cannot use the same analysis again. Because sometimes also we see situations in our videos when we give an analysis, we give an opinion on the video, it plays out, it gives the profit if you would follow it. But then maybe 2 months later, people watch the video and they say, oh yeah, it's kind of a positive. And they think it will always happen like this. So they enter, but you are already somewhere here, much lower. So it's completely different technical situation. So you need a new analysis there. That's why it's always important to see if the profit estimation, if the profit played. What does it mean? It means that if we went up to the level where we can take the profit, either from the first level or other levels, it's the end. So it's the end of discussion. It's the end of analysis. Then you need another one if you want to apply it. Let's imagine situation. Let's talk about second level, because we had 2 technical levels. Second level is, okay, we went to the first level, volatile. We didn't go high. We didn't go up. So we were not able to take the profit. And then the price went lower. Then we always estimate the second level, technical. So this is the level that can be clearly analyzed from support, resist lines, etc., from other parameters, where the price will rebound. And this is usually the very strong one. And there, if nothing else happens, it should really bounce upwards. This is the second level. Again, when the price goes here, it can volatile, again, can go higher. Again, once the profit estimation is taken, you can sell. So if you reach the profit estimation level, you can sell and take your profit. Why is it now lower a little bit? Because overall, when you buy at the second level, your average price will be lower. So if first your average price is, let's say here, the first level, when you buy it at the second level, another portion, your new average price will be inside of these two levels. So it will be in the middle. Let's draw it again. And then your average price will be probably somewhere here. Let's make it green. And this will be your average price. And if this is happening, it means that you don't need to wait. You don't need to wait until those highs, because your new profit, let it be 10%, will be maybe, so plus 10%, maybe somewhere here. It might be even lower than the first level, but still it's from overall your money. So you will be able to take the profit in given and profit estimation. And then you exit, you sell. Again, end of story, end of analysis. If it played from the second level with the profit estimation, it's end. You cannot use this video anymore. So we need a new one. You can request it if you like. So these are the two levels, the technicals. So these are the levels that can be expected. They can be seen. They can be estimated. One can be more, let's say, probable than another one. And then about the third level, situation might be happening or developing in such a way that actually it goes crazy. So news kicks in. We always call it negative catalyst risk, negative catalyst risk mitigation. So it could be news, market situation, fundamentals, whatever, from those first three drivers. Whatever kicks in, the price could just suddenly drop. And then we always say there is a we provide you where you can buy again. And this level is not expected, because first two levels you can expect. The third level is not expected. This is just kind of a news effect, let's say, simply speaking. Yeah? And this is the level. If the price, again, is not going here, it drops there, it's volatile, so you buy more. And then on rebounds, again, you can reach your profit and sell. And again, take your profit. So you are not going to exit with the end. At least you can exit with a draw in a worst case scenario. So then it will be end of the story. Again. So once this happens, it's the end of the story. So this is the way we trade. So these are three levels. Now you can say, well, okay, three levels, but actually, how should we buy through these three levels? And this is another interesting part that we do. Also, it's a nonlinear averaging down. So next to those three levels estimation, we also want to be always successful. So whenever we have our levels, let's draw them again. Whenever we buy through them, if we go lower, we want at any rebounds be immediately profitable. So if we have these three levels, let's quickly redraw them. Whenever you go lower, you want to be very close to your average down price. That's why we do so-called nonlinear averaging down. What does it mean? So now imagine you have these three levels. So it's the level 1, it's the level 2, and it's the level 3 here. So you have three levels. So at the first level, imagine we go with our price, does not work. So you buy here, doesn't work, we go lower again. You volatile, you buy, and now you buy more. So usually we have different portions placed. So what does it mean? It means that money that you have, you don't actually, so the money that you have, you don't, I will try to draw it like this, like a money. So the money that you want to play here, you don't put them in one level. So you split them. Split them in different portions. Usually we advise so-called 5-portion split. What does it mean if it's a usual situation? So 5-portion split usually means that all these money, so you can split them in 5 portions, in 5 smaller portions. And then you can buy with those portions through the levels. For example, the classical approach, it's usually the most advised at our channel, is so-called 5-portion play, meaning that at the first level you buy with 1 portion from all your money. Through the second level, if it goes there, you buy with 2 portions of your money. And then if it goes to the third level, you again buy with 2 portions of your money. So this way, your portion distribution will be like this: 1, 2, and 2. What does it mean? It means that if you buy at the first level and then it goes up, you make your profit. You make your profit only from 1 portion. Yes, this is kind of decreasing of your possible profit. But what's the positive about it? You mitigate your risks, because our strategy, our philosophy, we want to be successful. We don't want to lose money. We don't want to over-risk. That's why we say, let's keep more money as a reserve, because we also don't want to do stop loss. Sometimes, unfortunately, happens, but we don't want to do it. And that's why we distribute it like this through the levels. So you buy with 1 level. If it's not working, the first technical level, and the price goes to the second one, which we also discussed at our videos, then you can buy with 2 portions. So what does it mean? It means that your average price will be not in the middle between 2 levels, because if it would be 1-to-1, but it will be closer to the second one. It will be somewhere here. So whenever you rebounce back, it will be easier for you to make the profit from the profit estimation levels, because your profit will be then this one. It will be this one. This is very important. So that's why we do it. And of course, when you go to the third level, again, if it drops there, usually very rare case, and again, you buy with 2 portions, your average price will be also low. It will be even either at the middle or lower at the middle than the middle, because although it's only 2 portions of money, but because the price dropped, actually you will be able to buy more stocks, because your average price is not only formed by the portions of money you put into the level, but also to the price is also dependent on the price of the level. That's why it will be again somewhere in the middle. And whenever you have a rebound, you will be able either to make again the profit or exit with a draw if it will be only a small rebound. So this is very important. So this is indeed the way we want to trade. So we want to trade to make either a profit in the best case. In the worst case, it should be a draw. So we don't want to be red at our brokerage account. How to achieve this? Well, you achieve this with, of course, waiting a little bit, spending a little bit your time, because we do not do stop loss. So we spend our time, but we do not want to spend our money. So this is the strategy of non-linear averaging down and waiting. Those who like stop loss, I often also refer on it at our videos. Those who do stop loss, they actually do other way around. So they pay with money, but they don't want to lose the time. So they say, okay, I take the loss, but probably I will be faster to make the profit somewhere else. So this is so-called stop loss. And this is what we don't do. The reason we don't do it, because actually, why would you need the time so fast if you have those non-linear levels? Daily trader or intraday who trades with 15-minute candles, then of course you want to be fast. You want to make your profit within the same day. So it's okay to take to buy time with money, so to take stop loss. But if you are big guy, let's say, trading with huge monies, that's usually how big traders do, or if you are just seeking for a secondary source of income, and these are usually people seeking advice in YouTube, and probably majority of those who watch this video as well, then you don't want to sit at your monitor every day and sit at your PC, look at your monitor. So you want to check it maybe a couple of days later. And that's why it's okay for you to wait a little bit, but you still want to exit with the profit, or at least just exit with the draw. You don't want to lose your money. because it could be also very, let's say, psychologically very draining for you. That's why we follow this strategy. So it's a strategy for, to say it mathematically correct, to not have a loss. That's the strategy. So it's not losing money strategy. I'm not saying it's profit making, because if you don't lose money, it means either you just stay at the same level or you make the profit. So this is very safest side approach. Of course, sometimes it's not working. Sometimes you have really bad news, really bad news that can break this third level even lower. Well, then you have to take loss. But if you look at statistics at our channel, usually it's not the case. I think it only happens a couple of times in a year. Recent example, we have to admit, it was a TAL. We will make a video today about it. This was the situation when indeed the third level was estimated too high and it really dropped. So here, unfortunately, we all had to take the loss, stop loss, so cut losses. But in general, this is very rare situation. So percentage wise, it's maybe 1-2 incidents in a year. So overall, it should also pay back if you keep the same strategy at our channel. So this is the way of trading. Now let's look at the real example. Actually, we could look at the real example. What does it mean? Just any stock I picked up, and imagine now the situation that analysis was given, for example, here by end of March, beginning of April. Imagine we give the first level like this. So it will be something between 10.50 and, let's say, the next one would be just, I'm not really now going for precision, just to give you an idea. And let's say about 10, so between 10 and 10.50, something like this. So this is the first level. Now you buy in this first level with one portion, and then this would be your, let's say, averaged price here. Then you see what happened. We were volatiling. Okay, it was going with the profit, but let's say we said the profit should be 15% here. This would mean that we go at least to 11.50. So we were not able to take the profit. Let's put our profit level here. So this would be here. So it's actually from the profit taking from the first level, because it's 15% from overall money allocated in the position. If you go to the second level, the profit taking line declines, goes lower, but it doesn't mean that you take less profit. Actually, you take more profit. It's just a percentage calculation. So, so we were not able to take the profit at the first level, yeah, and then we decline. And then imagine the second level was given here, a little bit lower. And then we go to the second level, we kick it through, you buy in. Then your average price becomes here, so it lowers a little bit. And then we rebounce. And see, we rebounce, and then your, let's say, 15% will be somewhere like 10.53, because this line will lower, the dark line will lower. So it will be here. And indeed, we hit it. So we go high. You don't wait. You don't say, oh, I want to go higher. No, you just take your profit here. You take your profit here, and it's done. You exit. So now, what profit did you make? You played with 5 portions, and you played with 2 levels. So out of these 5 portions, you played actually with 3 portions of your money. And with 3 portions of your money, you were able to make 15% profit. What does it mean? It means that if all your money that you have are, let's say, $5,000, then each portion will be 1,000. So instead of using all 5,000 for risk and risking with those, you just keep it in portions, and you will employ here 3 portions, meaning 3,000 and making 15% of those. So you can calculate what it will be. That's the way of trading. So this is the strategy. This is the way we trade at our channel. It's a 3 levels, non-linear, averaging down, and risk mitigation. So that's why, and that's how technical analysis in this approach, we call it mixed analysis because it's not purely technical. We also take into account these additional components. It works. It works and allows you to make either a profit or at least a draw. But it takes some time. Sometimes it could be taking time. So this is the way of trading, and that's what we do at our channel. And if you like this video, don't forget to subscribe to our channel. That's the end actually. Let's make it green in the color of dollars. So that's how we trade. And again, to conclude, it's choose your stock, which is in technical. Then what we do is define, let's a little bit choose the font. So define the levels where we want to trade, 2 technical and 1 risks. Then we do non-linear average down for the levels, and we also of course provide the profit taking estimation, which we want to know when to exit. So profit taking estimation. So these are the 4 major components that we follow, let's say the 4 major steps that we follow at our channel. And usually what you see in the videos are the last 3. The first one you don't see it because these are the scripts that we use, let's say before the video is issued, before we go there. But there are scripts we run daily before the stocks are chosen. We choose those on the market, on US-based markets, mainly New York Stock Exchange and Nasdaq. And then after those stocks are picked up, we go with the 2nd, 3rd, and 4th step, which we discuss with you in the video. Then you see those levels. So that's the way we trade. That's what we do at Stocks Advisor channel. We call it mixed analysis because it's actually technical plus risk mitigation and nonlinear averaging down, so all together. If you like it, again, if you like this way of trading, mainly works very well. Again, a couple of times a year maybe is not working, but this is the case for any trading. You can never be winning all the time, but majority of time it's quite well. So then don't forget to subscribe, press the bell button, and if you like it, see you with real examples at another videos at our channel. Thank you.